There's an old adage that you learn more from mistakes than from successes. That seems especially true when it comes to investing, where a simple misstep can really cost you. And while there's countless ways to make an error as an investor, our guest this episode says she sees the same ones being made over and over.
Yeah, I often see similar pattern of mistakes.
That's Yuko Girard, portfolio manager on the multi-asset management team at Scotia Global Asset Management.
If you can avoid these things, you can really have much better success in achieving your financial goals.
She's here to break down 5 common investing mistakes she sees time and time again, from following fads to trying to time the markets and much more. Because sometimes instead of learning what you should do, it's easier to learn what not to do.
Right. All you have to do is remember, okay, these are the pitfalls. I shouldn't be doing this because this is the mistake a lot of people make.
I'm Stephen Maurice, and this is Perspectives. Yuko, welcome to the show. Thanks for joining us.
Thank you for having me.
Before we get into this, I should mention there are so many of these that we actually have enough to fill 2 episodes. So you have the first 5 for us today, and we'll have another episode down the road.
Exactly.
So let's get right into it. Common investing mistake number 1, not diversifying beyond tech. What do you mean by that?
Yeah, so maybe a lot of people heard about Magnificent 7.
That's Microsoft, Amazon, Meta, Apple, Alphabet, which is Google's parent company, NVIDIA, and Tesla.
Right. So there's basically 7 U.S. stocks that's really driving the market. And people feel like they have to get into it.
Right.
The problem is when you hear it's a great return or they had a great return, most likely it's too late to get in to begin with.
Right.
And a lot of time when this goes down, it all goes down together. So you don't want to have exposure to one segment of the economy. You do want to have different exposure to different industry, different region, different type of asset class, because each investment has a different performance pattern and they offset each other.
Right.
So it's better that when one is going up and one is going down, you kind of offset so you have a smoother ride to your goal. It's great to have some exposure, but it's not a good idea to have only that exposure. And the other thing is also investing is not just about selecting the right company. Mm-hmm. It's about how much you want to pay for that company. So a lot of time, it could be a great company, like if you hear Microsoft, Apple, it's a great company, but how much is it worth? Mm-hmm. And when everybody's excited, they tend to overpay for that. So even if it's a great company, if you overpay, the potential upside is quite limited and there's much more potential downside. So be aware of when to get in, how much you want to pay for those companies, even if you think they're very good.
Okay. So you're not saying don't invest in tech. You're just saying that might be part of your overall investment strategy, but not to focus just on that one thing.
Yeah.
Or any one thing, really, I guess.
Exactly.
So the first mistake is to focus all of your attention on one industry or one
region, one asset class.
Any one thing that puts you probably at greater risk if you're not diversified.
Mm-hmm.
Okay. Common mistake number 2, trying to time the market. Maybe explain, what does that mean to try and time the market?
Trying to time the market is basically when you see like the market coming down, mm-hmm. you want to get out of the market.
Right.
And then, for some reason, you see that the market hit the bottom and it's going to start to come back up. So you go back into the market.
Right.
If you can do that always successfully, you sell high and buy low. What often happens is the opposite, selling low and buying high.
Right.
Timing the market is very difficult, mm-hmm. and I haven't seen anybody do it successfully on a consistent basis. Sometimes, people can be lucky, but the difficult part is really not getting out of the market, but getting back into the market. Because getting back in is like you hit the bottom and it's starting to come back up, but you don't know that until you see the actual stats and you know that, this was the day that actually hit the bottom, because it's very choppy. It goes up and down the market. Mm-hmm. And the best time that the market performs is really soon after the bottom. That's the time that you have the best performing days. And a lot of people are already too scared. You got out of the market. You're still not sure if you want to go back in or not. So you miss those great days, and that can have a significant impact on your portfolio. And I have seen so many clients getting out, and it took them a year before they went back in. And by that time, the market went up 20, 30%. Now they're complaining why their portfolio is not doing well. It's because you try to time the market. So,
right.
And also when you stay in the market, once the market starts to come up, you're getting that compounding effect, return on top of the return. So you're getting more of that return. But if you kind of get out of the market, you start from scratch, like from zero, and you have to kind of start the compounding magic again. So it is really difficult to time the market, and I don't think that's the best way to invest.
Right. Are there occasions, though, where, if there is a big decline in the markets overall, should sometimes people look at that as a buying opportunity because the prices are lower, they can get stocks in maybe a company that they wanted for a lower price than they would have before?
Yeah, definitely. I think a lot of the professional investors are always looking for that. But it's scary because, yesterday went down 3-4%. Today, it could go down another 3-4%. So when do you actually go back in? So that's where you have to have a target price of a stock. Say, okay, this is a reasonable price that I feel comfortable buying it. Eventually, it should go up more than that.
Right.
So if you know that, it doesn't really matter where the market is going. If that stock hit that price, you're comfortable going in because you know the upside potential. So yeah, a lot of people, if you're very good at it, and a lot of professional investors, that's what they do. They wait for that market to come down and get back in because they know at what price they should go back in.
Right. And I guess that's hard for people to do when they see those big declines coming, to just stay focused and not be freaked out by volatility in the market.
Yeah, it is a scary thing, but investing, there's always that uncertainty. And that's why you're getting a much better return than, let's say, a GIC. Because you're getting rewarded for taking that uncertainty or the risk. So you should be ready for that. And there's a big decline every, 10 years. The last one we had was really 2020 was a little bit, but 2008 was the big one. And before that, it was like the tech bubble, so 2000. So it doesn't come often, but when it comes, it can get hit pretty hard. But within a few years, there's always that choppiness that you'll get like 5-10% decline. And that's normal for the stock market. So you should not be overreacting because if you look at the very long term, the market still continues to usually go up. So I don't look at my portfolio value every day because, you set the goal and you're on your journey to get there. Don't worry too much. And if you diversify your portfolio enough that there's different exposure, you should be able to go up in the longer term.
Right, to weather those storms of volatility.
Yeah.
Right. Okay, so that was common mistake number 2, trying to time the market. We'll avoid doing that.
Yeah.
Okay. Now, common mistake number 3, chasing returns. What do you mean by that?
Chasing returns, it's basically you see certain investment going up and so, I want to get into that too. So you're always kind of investing into something that already had a good return. You keep buying at a high, and then eventually there's more potential of those things that went up already to go down more. So I think chasing returns, you're kind of always behind on a potential upside. And it's not a great way because if you look at the probability, when returns are already high, most likely it's going to come down more than go up.
And what kind of problems have you seen people get into when they try to chase the markets? Is it just chasing fads, which the word chasing suggests? It's hard to catch.
Yeah, it's really hard to catch. Like my son, he just started working. Now he has some money, so he's excited. He thinks he found something that nobody knows. Oh, it had this great return, so I'm just going to go in. And then he says, oh, no, it didn't work out. So he sells it. So he buys it high. He sells it low. He keeps doing that. Eventually, he have no money to invest anymore. So a lot of people that start investing, they rely on the historical data. But what you really want to do is be forward-looking, the potential of the investment going up, and not what already happened.
Right. That kind of implies people doing research and, if you're going to invest in a company, should you be looking at its performance? Should you be looking at its multiples? Or do you leave it to somebody else to make those calls for you?
I mean, you can do it, but it's very time consuming.
Yeah.
I think it's better to leave it to the professionals who are doing it 24/7 instead of you trying to outsmart, because most likely you won't outsmart these people.
Okay, I think that probably leads quite well into the next potential investing misstep or mistake, not understanding that the market is not the economy. What does that mean?
So people tend to think if they see or hear we're going into recession or unemployment might be going up or, economy might be slowing down. That's the economy side of it, which is a business cycle. And market, especially stock market, there is some link, but it's a little different because economy, a lot of time when you read or when you hear about it, they're using backward-looking data. So what happened? So, okay, unemployment went up, so things are slowing down or people might start losing job. It's backward-looking. Market is a little bit forward-looking. So people are expecting, is a rate cut going to come? Therefore, there's going to be an impact to the market. So there's a little bit of that lag between what's happening in the economy versus the market. Mm-hmm. The other part of the market that's very tricky is the sentiment. So there's an investor sentiment. So when investors are willing to take that risk and very bullish, even if the economy is not doing that well, like right now, you hear these hypes about AI and people get all excited and they want to get in. So sometimes the economy is doing one thing, and then the market is just going up because everybody's bullish and wants to get into that stock market. So there is that disconnect a lot of time between economy and the market, and also there's a time lag between economy and the market.
But if you're an investor, shouldn't you be kind of paying attention to what's going on in the economy?
Yeah, definitely you have to be aware of it. Mm-hmm. Fundamentally, if you look at the stock price, there's two parts of it. So there's the part that is kind of how much is their profit growing. Mm-hmm. That is more linked to the economy.
Right.
So there's a higher correlation between that. But the other part is the multiple, we call it, but how much do you want to pay for that earning? And that's the part that gets up and down a lot depending on that sentiment. So when people are very bullish, they could be paying like 20 times, 30 times of the earning. 40 times, you can go up as much as possible. But then when people are not so excited about it, it can go down to 10 or 5. So that multiplier can have a big impact on the stock price. So yeah, one part of it is kind of linked to the economy, but the other part that's a little more volatile is more about that human psychology.
Okay, so that was common mistake number 4, thinking that the market is a direct reflection of what's going on in the economy. You're saying pay attention to it, be aware of it, but they don't necessarily move in lockstep.
Exactly.
Okay. That brings us to our 5th and final investing mistake for this episode. Investing based on potential election results.
Right. The thing is, it's more noise. Like they kind of drive the short-term price volatility depending on who wins or who's about to win, and it can flip-flop. But there's no real data that suggests when one party is winning, this part of the market is going to do well. Like it's very short term, and at the long term, it doesn't really matter. So we don't really change the way we invest depending on the elections or any kind of results. But we are aware of the short-term risk. So if we think that there's certain part of the market or sector or company that can get impacted, we may be reducing a little bit of that exposure. Mm-hmm. But really, you shouldn't be really changing the way you invest based on elections or geopolitics or those kind of news that you hear.
So is it sort of like what you were saying about the economy? I mean, you should be aware of it because different politicians have different platforms that could have different impacts on the economy. So you have to be aware of it, but not necessarily be making direct investing decisions on the basis of who might win an election.
Yeah. You have to be very patient when you're investing.
Right.
You absorb a lot of information, but you don't have to take action. Mm-hmm. You just have to be aware of what's happening and maybe adjust, but you don't want to have, overreacting to those kind of short-term noise or headlines. That's not the right way to invest, and you're probably not going to be too successful doing it that way.
Okay. We'll just quickly run through these potential mistakes people could make. Not diversifying beyond tech, which is just not diversifying generally, I suppose. It would apply to other sectors as well. Number 2 was trying to time the markets. We hear a lot about that, trying to figure out what's going to happen with a particular stock at a given time. Very tough to do. And chasing returns. Similarly, I guess you just drive yourself crazy by watching the fads and seeing what's going on.
Yeah.
Number 4, not understanding the market is not the economy. You need to be aware of it, but it's not everything, and they don't always march in lockstep. Common mistake number 5, investing based on potential election results. Again, pay attention to what's going on in the world, but it's not necessarily reflective of what's happening in the markets.
Exactly.
And overall, how should people avoid these mistakes? Like, what do you want people to take away from this episode?
Yeah, so I think I want the listeners to really take away 3 things. The first is when you're investing, you really want to have a clear goal in mind. Investment is really not about getting the highest return possible in the short term. It's really to achieve your financial goals. Right. So it could be buying your house or having a big trip or retirement. But once you know what the goal is, you kind of know how long you have, how much you want to achieve for that. And then that kind of leads to what kind of portfolio you should be selecting or putting together, and also what kind of risk you want to take.
Right.
You also are more disciplined when you kind of set that goal, and you're less likely to be worried day to day with negative news or market going up and down because you kind of set your journey. So you want to kind of leave it alone unless there's something that changed.
Okay, having a goal.
Right. And the second thing is when you're looking at investment opportunities and you hear great returns or opportunities, also think about the risk because return and risk come together. A lot of time when you hear about a great opportunity, you don't hear what the risk is.
Right.
Often the great return comes with a greater risk. And also figure out what kind of risk you're comfortable taking or you're able to take. And the third is a key concept of portfolio management, and it's really about diversification and compounding. So diversification is really about you want to have different exposure, and compounding is really that multiplication of you're getting a return on top of the return, so you can get to where you want to be much faster.
Right. And don't be looking at that stock ticker every day.
No.
All right, Yuko, thank you so much for joining us today. I really appreciate it. And we'll see you for part 2 of our conversation.
Thank you for having me.
I've been speaking with Yuko Girard, portfolio manager on the multi-asset management team at Scotia Global Asset Management. The Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time. This podcast has been prepared by the Bank of Nova Scotia and is provided for information purposes only. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments, including ETFs. Please read the prospectus before investing. The indicated rates of return are the historical annual compound total returns, including changes in unit values, and reinvestment of all distribution does not take into account sales, redemption, or option charges or income taxes payable by any security holder that would have reduced returns. Mutual funds and ETFs are not guaranteed. Their values change frequently, and past performance may not be repeated. Views expressed regarding a particular investment, economy, industry, or market sector should not be considered an indication of trading intent of any of the mutual funds managed by 1832 Asset Management LP. These views are not to be relied upon as investment advice, nor should they be considered a recommendation to buy or sell. These views are subject to change at any time based upon markets and other conditions, and we disclaim any responsibility to update such views. To the extent this audio contains information or data obtained from third-party sources, it is believed to be accurate and reliable as of the date of publication, but the Bank of Nova Scotia does not guarantee its accuracy or reliability. Nothing in this podcast is or should be relied upon as a promise or representation as to the future. The information provided is not intended to be investment advice. Investors should consult their own professional advisor for specific investment and/or tax advice tailored to their needs when planning to implement an investment strategy to ensure that individual circumstances are considered properly and action is taken based on the latest available information. Scotiabank includes the Bank of Nova Scotia and its subsidiaries and affiliates, including 1832 Asset Management LP and Scotia Securities Inc. Scotia Global Asset Management is a business name used by 1832 Asset Management LP, a limited partnership, the general partner of which is wholly owned by Scotiabank. Registered trademarks of the Bank of Nova Scotia used under license. Copyright 2024, the Bank of Nova Scotia, all rights reserved.